Oliver, Deutsche Bank has spent weeks preparing the ground for today's announcements. We knew about the dividend cut, we knew about the new structure, and we knew about the third quarter losses. But there must have been something new to say on the day because the shares have fallen nearly 6%. What's been going on?
Well, they've had a big announcement, their third quarter numbers, and a strategy update, as everyone expected. Maybe people were disappointed with the numbers themselves, which were pretty ugly. Maybe there were some details of the strategy update that people didn't like. Maybe the confirmation that the dividend will be cut for this year and next year. Who knows when it'll come back or at what level it will come back. Maybe also some disappointment on the scale of cost cuts. John Cryan, the new co-chief executive, said on the press call this morning that the board had been worried that people would think the cost cuts hadn't gone far enough. That said, they are pretty radical cuts. About 9,000 jobs are going to be lost off an employee base of 100,000, so they are cutting back quite heavily.
And I hear as well that in addition to sacking its staff, Deutsche is effectively also sacking some of its clients, which seems an unusual way to be going about things.
It is, yes. Mr. Cryan wants to reorganise and streamline the bank and pull out of unprofitable activities like a lot of other banks are. But it said in the investment bank it'll lose up to half of its clients from some of these areas which I guess are small or niche or not profitable for whatever reason. They're just going to pull out and leave their clients to go somewhere else if they still want that service to be done. But it all has to be seen in the context of what he's trying to do, which is to get to a target return on tangible equity of 10%, which is a target set out by Anshu Jain, his predecessor as co-chief executive. So it's all about how the bank is going to make that number.
So nothing has changed then, really, has it? If the target for return on equity is the same, what was the point of replacing Anshu Jain with John Cryan?
Well, John Cryan's point is that it's all about execution and that the bank is going in the same direction it has been for a long time and it knows where it wants to get to, but that the execution has been not very good. And it's hard to argue with that. Return on equity has been in sort of mid to low single digits for quarter after quarter after quarter. So what changes today is the execution and some of the details around that. For example, Mr. Cryan wants to have a higher capital ratio and he's not raising more money from shareholders to fund that, which means that he's going to have to make the bank a lot more profitable.
Hence the cost cuts.
Hence the cost cuts, and also reduce risk-weighted assets, hence the withdrawals from businesses. So he's going at it a slightly different way to the way Mr. Jain perhaps would have gone about it. But nevertheless, he is heading in the same direction.
So the good news is that there's no immediate risk of a capital raising. The bad news, I guess, is that John Cryan still has an awful lot to do. Oliver, thanks very much.